Hey Lou, what's going on? Yep, we're live. We're live. Let me know if you got any questions. Let me know where you're calling in from. I love to know where everyone is streaming from. We're gonna talk about the GameStop story, go a little bit deeper into what's going on in the marketplace. Happy to answer anything that's on your mind. We posted an article, a long article this morning. I'll go into some of the tidbits of what the highlights of the story are, what people should be informed on, who are the market players. Hey Lou, what else is happening in the economy? So without further ado, this week a group of retail traders took down a major hedge fund. The story involves a high stakes drama, billions of dollars, and one man's willingness to go to the moon. The GameStop trade war will definitely go down in financial history. So grab a seat. We've armed the rebels, and the revolution has begun. First up, who is GameStop? Millennials will remember that this is the retailer where you could buy used video games for 25 cents and only resell them at $25. So this establishment really took advantage of a lot of consumers in the marketplace because of this vintage era. They had over 5,000 stores across North America. A lot of the old brick and mortar retail stores, though, didn't keep up with the times. First in the story, we have two Wall Street experts, two contrarians that begin the story. If you've watched The Big Short, Dr. Mike Burry makes a comeback with this. He never wore shoes in the movie and was played by Christian Bale. But in August 2019, he made an initial investment in the video game retailer. At the time, the company was trading around $4 per share, and he made a cigar butt investment, something that Warren Buffett used to do with Ben Graham back in the 30s. Dr. Burry is known for making obscure investments in unloved companies. In our case, esports at the time has made billions of dollars with online gaming. So GameStop was losing market share with its physical stores. Less people were visiting the retailer every day. But as in The Big Short, Dr. Burry maintained a position like he did against the subprime housing markets and made 10 times his initial investment. Next up, the second contrarian is Ryan Cohen. He's a co-founder and CEO of Chewy.com. He left the company several years ago when he sold it to PetSmart for $3.3 billion. Along the way, in his retirement, he only invested in two stocks. One was Wells Fargo, the second being Apple. Both of them have done pretty well. But he decided that he'd like to add a third stock sometime last year. So in August 2020, he came in, bought $79 million worth of GameStop stock. At the time, he owned more than 10% of the company, and he sent an activist letter to the board in November. He actually received 3 board seats and was very strongly adamant about taking over the business with the management team to improve the economics and make it very interesting and very exciting in the esports era. Next up, we have the short sellers who enter the picture. Now, just like every story, there's a hero and a villain. This GameStop saga is no different and has very similar opposing forces. You see that large shareholders are required to disclose public stock positions. So in early 2021, a group of Robinhood investors found a gap in the financial markets. They began a public witch hunt of these short sellers that were shorting these bankrupt or poor fundamental businesses. The largest fundamental investor that was short selling GameStop was Melvin Capital, a multi-billion-dollar hedge fund run by Gabe Plotkin. He's one of the best investors on the street, but not for long when Main Street decided to go head on with him in the stock battle of the century. So GameSpot was a dying brand. Melvin Capital built a $55 million short position against the company, betting that the company will fail and they'll profit from the bankruptcy. Later on, we'll talk about what a short squeeze is and how to sell short a stock. But needless to say, when the stock went against them, Melvin Capital needed $3 billion from Citadel and 0.72 to meet margin requirements. Next, another player is Chamath Palihapitiya. On late Monday night, he actually came on Twitter, tweeted about asking what investment he should make in the marketplace, given so much demand and hype around GameStop. Shareholders decided to chime in. So he bought $100,000 worth of GameStop options at $115 strike price. He made a big bet on this business. So the next day, GameStop stock skyrocketed to $145 per share. He was well in the money. In fact, by Wednesday morning, he sold his position for more than 5x. I know what you're thinking. How did he make so much money so fast? We'll get to that part very soon. It's worth mentioning that he took his proceeds and his profit and his principal and donated it to the Barstool funds. We'll talk about the Barstool Sports owner as well, but Barstool funds is for small businesses. So he donated about $500,000. If you're just chiming in, feel free to ask any questions. Let me know your thoughts on the GameStop story. If you're involved, if you got involved anytime in the last week or two, what your thoughts are. I'd love to hear what's going on your side of the table. So now enters the rebels on the main street. Wall Street Bets are also known as WSB on Reddit, has a self-proclaimed king. His name's Deep Effin' Value. You can check his name up. I posted it on the Financier this morning, so you can look up the link. This mysterious user bought a mix of $50,000 to $100,000 worth of GameStop options and stock, and in less than 12 months, congrats, Lou. That's good. In less than 12 months, his single stock portfolio skyrocketed to $47 million. Yeah, you read that right. $47 million on one trade. You can see why this guy becomes a hero of the story. Main Street retail investors, or the Robin Hood rebels, as I like to call them, worship this guy. So also on August 21st, another retail investor chimed in and went bullish on GameStop as well. At the time, the stock was trading at $4.61 per share, or roughly $300 million in market cap. This is also the time Ryan Cohen had entered the picture. In the Financier, you can find a clip on this guy's investment research. He does a great job explaining the company, why it will become profitable, selling physical games, how the company will turn around, and how possible short squeeze may actually push the company's stock from $5 to $50 per share. Next is the founder of Barstool Sports. He made a major bet. I like to call him the people's champion. David Portnoy is the founder of Barstool Sports. Peak pandemic, this guy came in because all sports were shut down across America. So he was streaming daily day trading videos on Twitter and across different social platforms. He amassed over 1 million followers on Twitter, betting millions along the way. You know him from the One Bite Pizza reviews. And as mentioned before, he launched the Barstool Funds, raising over $30 million for small businesses. But that wasn't enough. During the short seller story, Dave intervened and made his own stake in the game. I think he's down about $2 million at the moment, but in the past 72 hours, Dave has called out every billionaire hedge fund, the Robinhood CEO, and all regulators interfering with the free markets. This time, he's been a very active voice on Twitter, defending Main Street along the way. And last but not least is our favorite, Elon. He comes in between rocket ships and electric cars. Good old Muskie tweets about GameStop into existence. He mentions the Wall Street Bets Reddit article, and then he talks about the retailer on about Tuesday afternoon, linking back to Wall Street Bets. And to add fuel to the fire, the Robinhood rebels came in, started buying more of the stock. You see, Elon Musk has actually had a head-on-head with regulators in the past. In a previous tweet, he talked about taking Tesla private, and the SEC fined him. So he has no real respect for the SEC, and he really stands for the people. Hey, Chris, good to see you. It's always nice. Let's see, Lou, what else you got? These which COO are you referring to? You can just mention the name. I don't think I've seen the name before. So now let's get to the story while Lou mentions the COO. Mid-January, Robinhood traders found a gap in the market. The GameStop stock was overborrowed, and there were very few shares left in the public markets to buy, which means a small investment in the stock would push the stock much higher. Redditors first stumbled across this idea on January 13th. The stock began to creep up from $19 to $39 per share. Main Street started building a big position in the company. Remember, the stock was worth about $4 per share in August. Before the activist letters, most investors didn't even know that the company was around or even existed. GameStop was closed in most major retail malls across America. So on January 19th, Citron Research tweeted 5 reasons on why GameStop is a sucker's bet. He attacked the Robinhood rebels head on. Citron is a notable hedge fund that publishes pretty good investment ideas on a regular basis, but this was not one of them. The Robinhood rebels saw right through Citron's research, started building a bigger position, and with a small float, the GameStop stocks began to short squeeze against the short sellers, like Melvin Capital and Citron. As the price began to rise, the borrowed shares became more expensive. And on Friday, January 22nd, just last week, the GameStop stock was at about $65 per share, more than 3x the price from 3 weeks ago. And the shorts were hurting. At this point, Citron was forced to exit their position at $90 per share and lost well over 100% on their first position, and was also the first casualty in this saga. Next, Wall Street Bets takes down Melvin Capital. Since the initial squeeze at $19 per share, Melvin Capital had already lost about $3 billion on this trade. The multi-billion-dollar hedge fund was overexposed to this one stock. So major investors like Citadel and Point72 had to cover their margin call, but the game was far from over. By Tuesday, January 26th, the stock was now hovering at $147 per share and building momentum. Other stocks with high short interest ratios watched their share prices more than double in a few days too. Now Wall Street was watching, and the Robinhood Reddit rebellion was beginning. Wall Street began targeting GameStop and other stocks held by hedge funds. Companies like AMC, Nokia, and BlackBerry were all making a comeback. Costcorp, the headphone manufacturer, went from $4 to over $108 in 4 days, all because Main Street investors decided to invest. So how did this happen? If you got any questions, feel free to chime in. If there are any players or story pieces I missed, I'd love to hear your side of the story as well. So let's begin with the short squeeze. Why did GameStop have a limited number of outstanding shares? As mentioned earlier, Melvin Capital and other hedge funds had a massive short position in the company. This had nothing to do with the retail business itself, only with the stock that trades on the public exchange. So you see, short selling is a bet that the stock will go down in value. Investors can go to market, borrow shares from someone else, sell those shares, and when the price drops, investors will buy back the shares at a lower price, and you guessed it, profit from the difference. If the price goes up, and the investors will lose money along the way. Stick with me because short squeezes can be confusing. So if you got any questions, feel free to comment as always. A short squeeze can force investors to exit their position. You see, borrowing stock creates unlimited loss potential and requires a lot more margin. If the stock price keeps going up against the original sales price, the investors will need to cover the difference. For example, if the stock is at $10 and it goes down to $8, you could buy it back at $8 and make the $2 difference in profit. But if the stock goes down to $23, you need to buy back the stock at $23 and then come up with the $13 difference. Now imagine this scenario, but 10x the difference. GameStop went from $19.95 to $347.51 in the matter of 2 weeks. That's a multi-billion-dollar margin call. So how do option pricing affect the stock price? First, options are the derivatives of the underlying security. Options are priced based on the stock price. Different variables such as time, volatility go into pricing options. But let's keep it simple. Buying a call option gives you the ability to purchase 100 shares of a stock at a specific strike price. Remember, if someone is always on the other side of the trade, so if you're buying, someone else is selling. And 100 shares per contract is a lot of risk and a lot of leverage. Every time the stock price moves, the option price moves too. But it's a rate of change in the stock that matters the most. This rate of change is called delta. It's the first derivative, and it doesn't stop there. The rate of change in the delta is called gamma, also known as a second derivative. This is where option pricing gets complicated and affects the stock price. I know it's a lot to take in, but bear with me now. Wall Street loves taking risks. Hedge funds and market makers use derivatives to manage risks or take risks. Buying an option requires a small premium to purchase the contract. And at an expiration date, if your option is in the money, you will take delivery of 100 shares. A simple transaction if the option buyer wants to own 100 shares of GameStop. But if you are a market maker, you are hedging your position at every moment. Every time you buy a call option, the market maker will sell the contract and buy shares to maintain a neutral position in the stock. Options give market makers the ability to manage risk with less capital. But as the stock price changes, the market maker's risk exposure changes as well. If the stock continues to rise above the stock price, the market maker will have to buy back the stock at a higher price. And if the stock goes too high, the market maker will have a bigger loss. The number of shares the market maker purchases is based on the delta of the option contract. The delta rate ranges from 0 to 1. And as delta and gamma increases, the market maker is taking on more risk and needs more shares. As investors buy more out of the money calls, the market makers need to buy more shares, creating a never-ending cycle of buying stocks to hedge a risky position. This created momentum with GameStop, lots of momentum. If the stock skyrockets to the moon, then we'll experience a gamma squeeze, pushing the stock even higher. So at this point, Main Street storms the financial capital. The Robinhood app, if you haven't used it before, it's very easy to buy option contracts. So the purchase volume broke record highs this week. If you have the Robinhood app, I'd love to know. If you use someone else or move to another app, let me know in the comments below. So when the purchase volume on the option contracts hit record highs this week, it forced market makers to buy an unbelievable amount of GameStop stock to hedge their position. This drove the stock price from $70 to $350 per share from only Monday to Thursday. So this week we had a short squeeze and a gamma squeeze, pushing this GameStop stock to an unbelievable level. The market cap of the company peaked around $26 billion. It was around $300 million in August, with no material changes to the company except a high-octane trading environment. This is not the end of the GameStop saga, only the beginning. I think Robinhood and other brokerages stopped trading most of these several volatile stocks like GameStop on Thursday. They brought back trading today on Friday, but I think it's restricted. Once these stocks were halted on GameStop, Robinhood and others fell more than 50% midday to around $200 per share. Retail investors had begun moving their assets to other brokers like public.com. But it seems like Redditors on Wall Street Bets still believe in GameStop. It's gone up this morning, and I think they'll continue buying it. There's no telling how the story will end. What I do know is that many uninformed investors, retail investors, will get burned during this volatility, but they may take down one or two hedge funds along the way and show Wall Street who's in charge. So I think it's a pretty exciting story. There's a lot more to learn from this. There's a lot that's happening on the consumer level, at the retail level, whether they're sophisticated or uninformed, they're learning along the way. Apps like Robinhood and Publix.com are allowing investors to buy stocks for very low commissions. It is important to realize that commission-free trading platforms like Robinhood, they sell your information to other funds. They have to make money on the back end of a trade, so they're not charging for upfront fees. So it's definitely it doesn't hurt to pay a small fee at another more notable brokerage house. It's definitely helpful to have them, protect you, to have better execution. They won't restrict trades, to have more capital and access to liquidity. Yesterday, Robinhood's CEO mentioned that They do have a liquidity problem. They had to take down 2 large credit lines from Goldman and JP Morgan. This morning, they mentioned they needed an additional $1 billion to stay afloat. So there's a lot happening in the marketplace. Robinhood is very unstable at the current moment in time. I am betting that they have lost billions in assets. A lot of people are very upset. I watched the Wall Street Bets group on Reddit go from 2 million. I've been looking at this group for years. So I've seen it grow from like 1 million plus to what now is 5.7 million or something users over the last 3 weeks. So it's pretty crazy how many people have just jumped on the bandwagon, are reading the stories. CNBC is reading the stories. Everybody's getting the information from one source. It's really a battle between Main Street and Wall Street. I'm sure people are still holding shorts against GameStop. If they're not, people are still playing a lot. I think, Lou, you're right. A lot of the SEC regulations caused a ton of red flags. There's a lot more to come out of this. I'm sure people were pumping the stock at certain points too. So there's a lot. I think we'll learn in the next few months. I'm sure there'll be a lot of fraud that's related here. A lot of lawsuits have already been opened up. But it's a pretty exciting story. There's definitely a lot to learn from this. I'm going to keep my eyes open, keep reading more about what's going on in the marketplace, see what's happening to stocks like this, and learn how investors are taking advantage, consumers are taking advantage of better information and making money along the way. So it was great doing this live interview. It's definitely different from the usual Financier episodes we host every Friday. You can also read more of the details on the newsletter that we posted on the Financier on LinkedIn or at techfinancier.com. This video will also be available on YouTube. It's live streaming on Twitter and on YouTube. So if you have any questions, always feel free to reach out. I love talking about investing. I love talking about, thank you, Chris. I love talking about everything that's going on in the marketplace. So there's a lot more going on today, a lot more that's going to happen next week. This is only the beginning. This is just January. It's barely ended. There's a lot more going on in the world. The pandemic is not over. I definitely recommend donating to Barstool Funds. They've raised millions and millions of dollars. There's a lot more that's needed for small businesses. We're still in a pandemic. We're locked down. So people are looking for ways to, de-stress. They're trading, they're gambling, they're doing all of this. But it's an exciting story. We still have to come out of this very strong. So thank you, everybody, for joining in. Thank you, everybody, for commenting, asking questions, and partaking. Yeah, Raj, maybe I'll move it into the afternoons going forward. I think that might make sense for some people. I got to keep testing this. We've done a dozen of these videos. We've done a dozen during the week. So I'll test different times. I think it will work better in the afternoons or evenings. So without anything else, if nobody else has any questions, I'll be signing off. It was great talking to everybody. Great seeing everybody again. And until next time, we'll keep following the GameStop story and see what else Wall Street and Main Street have up their sleeves next week.